Hi, and welcome to your episode 4 bonus interview. You won't want to miss this one. Marco Santarelli is the founder and CEO of Narada Real Estate Investments and a well-known podcaster. In this bonus interview, he's going to show you how 90% of millionaires created more wealth through real estate than any other investment. He also has a 2-step wealth building blueprint you can use to build endless streams of active income. Even better, what Marco's going to show you can work for anyone regardless of how old you are or where you are in life. And remember, if you click to buy Wealth Breakthroughs right now, you get to jump ahead, own the entire series, and hear from Marco and the 39 other experts we interviewed. Settle in for a good one. Here's Marco. Marco, thanks for taking some time with us today.
Thank you, Patrick. Glad to be here.
So you're a big fan of real estate investing. So how did that come about? What got you into real estate?
Well, I don't know how, but at a very early age, I just knew I wanted to be wealthy. And this probably happened when I was in the range of 8 to 10 years old. So I made it my mission at the time to study wealth, business, money, whatever it could be. And I just became an entrepreneur at an early age. In fact, I was coding at the age of 13. I couldn't buy real estate, but I was studying real estate in my teens. When I turned 18, I bought my first rental property. It was a townhome unit. I bought it, fixed it up, I leased it, I managed it myself, held it for a number of years. The biggest mistake I made at the time, not knowing it at the time, is I sold that property. But that's when the writing was on the wall. And I just continued going down that direction. I got my license, continued to buy real estate, and learned as I went.
Did you go to college or you went right into business?
I went to university, and interestingly enough, I took criminology.
Huh.
Had nothing to do with business, but I thought that law enforcement was what I wanted to do. But I realized that, number one, it wasn't my passion. Number two, I couldn't make the type of income to create the wealth and sustain the wealth that I wanted. So I shifted gears and I became an entrepreneur, started some businesses, and invested in real estate.
And has it pretty much been real estate from day one for you, or any other businesses that you were in?
The short answer to that is I've had multiple businesses and therefore multiple failures, and experience is the best teacher. So when you can fail fast and fail forward, you build on your past experience and success to do better and create more the next time you move forward. That happened with real estate, but it also helped me with business. But I combined all that experience together to help me not only invest in real estate personally as an investment, but to create a business wrapped around real estate investing. So now I can show other people and teach other people what I was doing happily, and that's what I'm ultimately passionate about.
When you were young and self-studying, were there any particular influences that stand out?
Early on, it was Tony Robbins. I still have to this day the Personal Power Program on audio cassette with the journal.
Right.
And I have my values, my goals written in that. But he was an influence. Brian Tracy was an influence. I don't think I had a lot of mentors early on in the real estate space. I just knew from conversations with other people that real estate has been and always was the true wealth creator. I mean, wealth is held in real estate, but if you know the right strategies, you can create and build wealth rapidly using real estate. So not only did I come to learn quickly at an early age that real estate was a wealth creator, but it was a way to create enough passive income that you could become financially free. And knowing that as a teenager, I decided to pursue that and build as much income as I possibly could to funnel into investment real estate. Because if you can do that, if you can figure that part out, the key to creating wealth is actually to learn how to create as much active income as you can and convert that into passive income. Because the more passive income you have, the faster you will achieve financial freedom. So the key to going from active or earned income to passive and portfolio income is really the key to creating financial wealth.
So do you make like a distinction between income and wealth, or being rich, say, because you're a high earner, versus having true wealth, or are they kind of the same thing to you?
They're related, but there's a distinction. So when we talk about wealth, let's differentiate wealth and being rich. Okay. So someone who is truly wealthy, financially speaking, will always be wealthy. Why? Because we're talking about streams of income. You have passive income. It's predictable, it's sustainable, and it's passive. someone who's rich might look good on the surface. They may have a lot of possessions. They may have a lot of money in the bank. But the reality is that we're talking about chunks of cash. So if you burn through it, if you have $1 million and you're living off $100,000 a year, you can sustain yourself for 10 years. But then what happens? At that point, you're broke. The wealthy person now has passive income that's sustainable and predictable every single month, every single year, that they can survive forever. And not only that, pass it on to their heirs. So when you're truly wealthy, you have the ability to sustain and hold your wealth and your lifestyle and more so, whatever you want to do. You have the freedom. Not only it's financial freedom, but time freedom. You have that. You don't have that if you're rich. So the income from being wealthy comes from the passive income that you have from your assets, the assets that you build to create that passive income, like the real estate that I was buying. The reason I bought the real estate was to create the wealth through equity that I can now turn into more real estate that kicks off a steady stream of passive income. So now I have the passive income to create the financial freedom I need, yet keeping the equity at the same time. That's true wealth.
Did anybody in your family, your parents or other people, were they like have the type of personality you did toward wealth creation or having wealth breakthroughs, or was it a different upbringing for you?
I wasn't born with a silver spoon in my mouth. Both my parents worked, sometimes 2 jobs. I did not come from wealth. In fact, my parents were immigrants from Italy. So my mother worked 2 jobs for the longest time to make ends meet. My father was extremely conservative. He did not want to buy a house. He did not want to invest in a business. My mother was completely the opposite. She was entrepreneurial, and my father held her back. But recognizing that, I got a taste of both mindsets. But I chose my own path. I just knew, again, early on, that I did not want to work 9 to 5. I did not want a job, which some people refer to as just over broke.
Right.
The reality is that about 60% of the U.S. population doesn't have a financial plan. 47% can't even put $500 together in the case of an emergency. 50% of the U.S. population doesn't even have $500 in savings. Right. It's a pretty scary thing. That doesn't necessarily mean that real estate investing is not attainable for most people. I'll never say it's attainable for everybody because it's just not right for everybody. But I never came from, an environment of wealth or riches or even education for that matter. I went to public school, but I found my own way. I just identified with it.
And you're first generation here, then?
Yes.
Wow. So that's quite a American dream success story in a sense. Parents, son of immigrants that finds his own way. So what are most of your business activities now?
I actually have my finger in 5 businesses. The core business is the real estate investment business, where we freely provide knowledge, education, resources to real estate investors or wannabe real estate investors. I just call them people. And ultimately, it's not about the education. It's actually about taking action and building a real estate portfolio. So now you have that passive income and you are creating wealth. So once you have the education and you have the willingness and the ability to invest, we have properties in 22 different markets around the country at any given time. They're completely turnkey ready, tenant occupied, professionally managed.
So you do like a vetting process for people ahead of time that want to invest in real estate?
Yeah, it's a system that I created. I mean, to give you the history of the system, really, it happened back in late 2003 when real estate was on fire. Right. Markets were appreciating all around the country. I chose to get back into real estate investing, but full time, because I just come out of a dot-com crash at the time. I was the 3rd co-founder of a dot-com business.
Painful.
Very painful.
Yeah.
It's one of those rags to riches stories where you think you're going to be a multimillionaire overnight, and we were on that path. But when the NASDAQ crashed, all the venture capital funding dried up, and we had to close the business. We had to shut it down, and I had to lay off 105 people.
So with that, how important is it for people to understand that, because we could sit here, have a conversation, talk about all the wealth you built in real estate, how you advise other people to do it, et cetera, and boy, isn't this great. But maybe what people don't hear are the times where, the dark night of the soul, you think you're going to be a millionaire, there's a dot-com. So how do you overcome that psychologically and keep going to rebuild and to find new ground to stand on to be able to create wealth?
You really need to be clear about what you're trying to achieve. You need to have a purpose. You need to know what you want, and you need to have written goals. I know you hear this time and time and time again. The reality is a small percentage of people actually sit down, think about what they want, and write down their goals. It's not a hard exercise, but there's something about doing that that puts in motion the things that you need to do in order to get on the path to gain the knowledge you need in order to get to that next level, build the team, and start executing on whatever your plan is.
So this is kind of important because, especially coming from, you said, some of the influences like Tony Robbins or Brian Tracy, who were all about goal setting, right? And documenting what it is you want to make happen. So you talk about, hey, it's not that hard, and this is why it's important. What do you think the psychology is of someone who says, I have ambition, but they won't get to a point where they'll start writing down goals? What are they telling themselves, or what do you think that means? How do you interpret that?
If they don't have the ambition, they probably don't have clear enough goals, or they don't have a burning desire. They really don't want it bad enough, because we all have the same amount of time. We choose to do what we do in that time. And so whatever's driving you to do what you do is where you put your priority. If you're watching TV every night for 3 hours, clearly that, you're either really lazy or you don't have clear, specific, measurable, attainable goals that excite you, that fire you up, that make you want to do something better for yourself, for your family, for your legacy, your heirs. But when you can create that passion, you will take action. You will do what it takes. You will build a team around you to execute on the plans that you build. It's not that hard. People just hold themselves back through fear. They talk themselves out of what they could do. Look, to get results, you need 3 things. You need the ability, the willingness, and the execution. If you have those 3 things, you can achieve almost anything.
That makes perfect sense. So let me ask this in your perspective. What aspect or what ratio would you say of your success personally, and maybe we could extrapolate this as a general rule, is your headspace, and what ratio of the outcome is you choosing real estate as the vehicle? Like, so because some people say, real estate's just a great investment. And I heard you say not for everybody. It's maybe for a lot of people, and it certainly is for you. But how much of it is if somebody's trying to have a wealth breakthrough right now, they're trying to say, I just want to get on a path and break through and become wealthy. So some might say, real estate is the path. Could be true, but how much of that is their headspace?
90%.
Wow. Okay, so I wasn't expecting that answer.
The reason it's 90% is because everything starts, ends, and lives in your head. What you do, what you achieve, and what you don't do, and what you don't achieve, all starts from your mindset. The great book, Think and Grow Rich, Napoleon Hill talks about this extensively. That's why that book is worth reading at least once a year. I'm part of 5 masterminds. I was part of 7. It's very time consuming, but I want to surround myself with like-minded people.
And incidentally, I'd say the investment in these masterminds is not small, right? I mean, some of them are as much as $25,000 a year or so.
I have friends that have $100,000 masterminds. Right. I have 3 friends that have $100,000 masterminds. I'm not in those ones, but I am in the $25,000, $35,000 masterminds. Why do I do that? Because I want to surround myself with like-minded people who are goal-oriented, achieving the same types of things that I want to achieve, or maybe not, but they're all trying to better themselves. They believe in personal development. They believe in growth. They want to better themselves and achieve more. So I go there to learn, to grow personally, inside and outside. It's not just the information I get from the mastermind, but it's the networking and the growth that I get from it. But mindset is so critically important. You have to, first of all, believe that you can achieve what you want to achieve. And if you don't feel that way, follow my first rule of my 10 rules for successful real estate investing, and that is educate yourself. If you just sit down for a couple of hours a week and read a book, and just set a goal to finish a book every week or 2, on real estate, on anything personal development, from Brian Tracy, Tony Robbins, whatever it may be, Awaken the Giant Within, whatever it is, you will start to believe that you can achieve more than what you're actually doing, because your limiting factor typically is either you. And if it's not you, it's the 5 friends that you hang around with the most. Right. Because if you average out their income, it's probably going to be what you're ultimately going to earn and make. So if you are broke, find 5 new friends.
Who aren't. So
Right.
if I were to ask you, okay, I'm going to get started on this path. I want to read a real estate book or a real estate investment book. What's the first thing that pops into your head?
Well, fundamentally, it's Rich Dad, Poor Dad. And the reason I say that, not that it's a tactical book that's going to give you the how-tos. I mean, we teach the how-tos, but getting into a space where you get out of the matrix, to use that analogy of the movie, where you understand what assets are, what cash flow really means, what income-producing assets are for, and the difference between consumerism and investing and all that stuff. You really need to start there and then build upon that. So the entire Rich Dad book series is a great place to start. Gary Keller's book, Millionaire Real Estate Investor, is another great book. This is going to give you a lot of the mindset, and it's going to give you a lot of the strategy that you need. There's still more to be learned in terms of the tactics, but then that gets to the question of, am I an active real estate investor or am I a passive real estate investor?
Which are you?
Well, I'm both, but that's because I'm a full-time real estate investor and I have the time and the knowledge and the ability to do it. But if someone came to me and said, what should I be? I would say, look, stop watching, TV and all these, flipping shows, because that really is not real estate investing by my definition. When you're fixing and flipping properties, you're making, again, chunks of cash. It's transactional. It only lives for as long as you're actually doing the active job of buying distressed properties, fixing them up and flipping them, assuming you're making money at it, because you can lose a lot of money just as easily as you can make money. Right. But a lot of people have been kind of brainwashed into thinking that, that's real estate investing. It's a form of real estate investing, but you're putting up all the capital, the time, the energy, the knowledge, and taking on the risk to do that. Real investing means that you're acquiring and building a portfolio of income-producing assets that are generating passive income, so that way you don't have to work every month or every year. You can live off of the income from your assets. And it doesn't have to be real estate. It could be other stuff, but I just happen to love real estate because it is the most powerful wealth creation tool, and you could do it the fastest. So for the most part, if I had to pick one, absolutely, I'd be a passive real estate investor.
You help people achieve their own wealth breakthroughs, I guess, through your educational services, in part at least. So let's say I'm somebody who, I want this now. I decide I'm going to get on a path here. I want to walk, I walk into your environment, your services, and I say, okay, here I am. How do I get started? What are the steps that you take me through to turn me into a real estate investor that can build wealth?
So 99% of the time when someone actually contacts us, whether by phone or on our website, they have two things. It's what I call their capacity. Capacity comes down to two things, cash and credit. So credit is the ability to qualify for long-term financing, essentially a 30-year fixed-rate mortgage, which is beautiful. It's great debt, not good debt, it's great debt. So the capacity to qualify, the credit to qualify, and the capacity, meaning the capital, you can invest with as little as $18,000, $20,000, $25,000, because let's face it, most of the income-producing real estate that builds a great portfolio is in the range of $100,000 to $200,000 for a normal 3-bedroom, 2-bath home in a good quality neighborhood, what I'll call a B-plus neighborhood. So that's all you really need in terms of capacity. So when those people come to us, they've already somewhat self-selected themselves and educated themselves, and a lot of times it's because of our podcast or books that they've been reading, such as the ones we just talked about. And now they're saying, hey, I'm ready. I'm willing to move forward. I just need someone to hold my hand, and I need the team. So the reason they would come to us, and I don't say this to be, a pitch or, self-promotion, but the reality is we have already vetted all the teams of people that you would need in 20 to 25 different markets.
So let's talk about what, who needs to be on this team. So pretend for a minute you don't exist, but, as far as you don't have a team or something to plug in, and I'm trying to go out, figure this out, learn how to do this. So assuming you didn't have that team, now you say, okay, you check, what kind of capital I have, what kind of credit do I have, and I've got the ability to get started from those two things. What's the next thing I do?
The starting point is to build your team, but the starting point to that is really to have a conversation or two, what I call a strategy session, with someone who's already an experienced real estate investor and can hold your hand and guide you along. And for us, we call them investment counselors because they're essentially counseling you.
So what's the key? So let's say you didn't have a team when you got started. It was you basically figuring it out. So you found property. You had certain criteria around it, I'm assuming. So what kind of criteria I'm looking for?
So okay, great question. So now that builds out to a whole other conversation. So when I first started in late 2003, early 2004. I was living in Orange County, California, and I was investing 2,000 to 3,000 miles away from Florida all the way up to Michigan. I didn't have a team. I had to build my team. So I had to not only find and vet the people that were going to be on my team, but I had to create the systems that would allow me to invest from a long distance and do it successfully. And sure, I've lost a lot of money in the process. I've tripped, fell, got kicked in the gut.
And that's actually important. So let's go into the mistakes. So the roles for the team are what? I guess you need a realtor to find property for you, right? That you can trust, that knows what you're looking for. Is a part of that team a banker or a lender, somebody that is predisposed to understanding you and being able to lend?
So let's address that question first. So here are the key people on your team. There's going to be more. You need an acquisitions person. It may not be a realtor. It just depends on what your strategy is. But essentially someone who's going to bring you the deals. Okay, it could be a new home builder. It could be a turnkey real estate provider. It could be a real estate agent or broker where they're just pulling it off the MLS. Maybe you're dealing with a wholesaler because you're doing some of the work. It's an active approach that becomes a passive investment. So your acquisitions person. Second, you need financing. So you're going to need lenders and mortgage brokers to be able to get you the financing because you could leverage your money 5 to 1, which is fantastic. You need property management, key person on your team. Property management is critical. In fact, I jokingly say you live and die by your property manager. So you really need professional full-service property management in all the markets, unless you're managing it yourself.
What do you allocate for a percentage of the income to property management?
I always budget 10%. The reality is because of the relationships we have, it'll range from 7 to 10. It averages 8%.
Okay.
But at the end of the day, I'm not going to nickel and dime my property manager.
Right.
The cost difference between 8, 9, and 10% is nominal. I just want to have great management, and I want my manager focusing on me and my inventory, my portfolio, in other words, my assets, as much as possible. Because at the end of the day, I want them leased for as long as possible. The expense in owning property is not that 8, 9, 10% management fee. It's really the turnover. The turns are the costly expenses in owning investment property. Now it's a built-in cost. You expect it, you budget for it, and you plan for it. So it's not like it's going to be a shock or a surprise. But the longer you maintain and keep a tenant without having that turnover, the more of that cash flow or positive cash flow you retain.
So we got 3 key members of the team. Somebody to help with acquisition, lender, and property management, professional property management, I think is the term used. What other members do you think are necessary?
Well, I'll add 2 more to that list because these are people that you're in communication with on a regular basis, be it monthly, quarterly, semi-annually, or annually. And that is your asset protection attorney and your tax advisor. You'll always be working with a tax advisor because your tax situation will change from year to year, and you always want to minimize, reduce, and eliminate taxes. And so tax advisor will be the key person on your team for that. And
are they specialists pretty much in this area? They need to specialize here, or a typical tax advisor would work?
I would say that they need to be specialized enough in the sense that they truly understand investment real estate and the tax laws surrounding it. Ideally, if they're real estate investors themselves, you can probably be assured that they understand it.
Yeah. That's actually a really good little thing. Do you invest in real estate? Good.
Right.
You can work with me. Yeah.
Right, exactly.
Yeah, I like that.
And then that person is going to be in communication with your asset protection attorney from time to time because all the entities that you have as asset protection vehicles have to fit the financial strategy that you have that's being set up by your financial advisor. So there is tax impact or implications for each entity that you set up and where you reside and what states you invest in. So those 2 people are going to be communicating.
When we interviewed Robert Kiyosaki for a previous series, he talked about the great tax advantage, and others have too, in real estate investment. So can you walk me through that? Like what, if I'm somebody that says, hey, I want to it's hard to accumulate wealth when you're getting taxed to death. As soon as you start making more money, you get less of it, and it's like, how do you start to accumulate any real wealth? But it seems that through real estate investment, there's ways to get great tax advantage. Can you speak to that a bit?
Yeah, so not being a CPA or a tax advisor, I will give you kind of the nuts and bolts. Essentially, if you do it right, you can own real estate, income producing real estate, and build a portfolio and become not only wealthy, but rich at the same time without paying tax. Which means that it's not that you're breaking rules or avoiding to pay tax. What you're doing is you're deferring, you're minimizing your tax impact, and you're deferring tax. Done the right way, you could defer it forever. And then ultimately, when you pass your portfolio down to your heirs, there's a reset in the cost basis of that portfolio, where now the people who inherit your real estate portfolio are starting at a new cost basis, so they don't pay any tax. But the short answer to your question, to get to that, is number one, you have passive income coming from your properties. When your taxes are done right by your tax advisor, the depreciation that you get from the properties can minimize or essentially eliminate the tax impact from that passive income. That's the first. There's a second as well. The second is the fact that you build equity over time in your portfolio, which creates net worth, creates wealth. And then you take that and you build more wealth, which is something we can talk about. But if you were to sell that property, you would be responsible for paying capital gains taxes.
Right.
But if you do something through the magic of what's called a 1031 tax deferred exchange, which is just the tax code in the IRS book called 1031, it allows you to effectively sell property and take the equity and roll it into other real estate, more real estate, which allows you to accelerate your wealth creation because now you're leveraging up and building a larger portfolio quickly from the equity gains from the previous properties. And you don't have to pay taxes on that, or at least not now. And if you do it right, ever.
You basically just keep deferring it. So if I were to do, maybe a high-level walkthrough, if I'm understanding you correctly, basically you've got, you can offset your passive income from a tax advantage that there is as far as depreciating the property. And so when you pay 20% down, you only have 20% capital in, but you depreciate 100% of whatever the value of the property is over some period of time. And then when you do sell and you have the windfall, rather than paying tax on the windfall when it happens, you can reinvest, and then you can keep deferring that tax as you keep doing that. So I see how as you're expanding and growing, and especially if you're using debt to acquire the properties, you're offsetting income. That's how they're not paying taxes, and they keep deferring it down the road.
Yeah, just to drill down into both of those just a little bit more for the sake of clarity. The depreciation on residential real estate, like 1 to 4 unit properties, is 27 and a half years. Why 27 and a half years? I have no idea. I don't know where that number came from, but that's just what the IRS
Some
said.
negotiation, yeah.
Right. So you take the improvements, which is everything but the dirt, because the dirt won't depreciate. But you take everything else, the sticks and bricks that sit on the dirt. The IRS will allow you to take 1/27.5 as a fraction of that every year without spending a dime. So it's a non-cash deduction, which is amazing, which means you don't have to spend a single penny to get that deduction, that depreciation.
Right.
Now, again, if it's done right, you'll never have to recapture that later because you can keep rolling your equity into new properties, and there's adjustments
basically
along the way.
it's the government saying we want you to keep investing in real estate. So that's why they give you that incentive rather than you can defer your tax if you'll put money into real estate again, so that they want to hold up the real estate market through that tax incentive. Yeah. So it's really So now I see. Well, this is why maybe real estate. I don't know of any other area to invest where you get that kind of advantage.
There really isn't. I mean, have you ever known the government to be good at creating affordable, safe, clean, affordable housing for people?
No, that never happens.
Right. They don't know how, and they're terrible at it. But they know that entrepreneurs and individual investors like you and I can do it and do it well. So they incentivize us through the tax code to do the things that they can't do well. So that's really what the tax code is if you look at it. Most of it is about deductions, not about taxation.
So let's talk about maybe then, maybe a little bit more the spiritual side of this for you, because, obviously you had a desire to, be wealthy. You created, this real estate business that you have toward that end, and that's satisfying in and of itself. But is there a spiritual side of this saying, I like the idea that I go to work every day and what we do translates into clean, affordable housing, safe, affordable housing for people. Does that ring into your experience at all?
The spiritual side probably lies within my overall mission. So my personal mission has become the company's mission, and that is to help 1 million people create wealth and passive income through real estate so they can become financially free. Mm-hmm. So that's our company's mission. That was my personal mission. It's just become the company's mission. It's the vehicle to help fulfill that. So the reality is we're in a country where the population is growing rapidly. In fact, the population is growing faster than the number of housing units we create every year. Mm-hmm. So that provides a phenomenal opportunity for us because people need a place to live. Whether they're buying or renting, mm-hmm. they need to come to somebody who's providing them that service. Right. Your tenant is a customer of yours. You have to look at your real estate business as a business and treat it that way and operate it that way. So if I'm providing you safe, clean, functional housing, and you're paying me $1,000 or $1,500 a month in rent, and you're happy living where you live, and I'm treating you well, I'm happy, you're happy, it's a win-win. The city's happy, they get their property taxes, the community's happy because it's not a vacant property. It's just an all-around win. So if you can keep doing that, feel good about it, so you're providing a valuable service, that's the best way to invest.
Yeah. So your activities now, as you said, you do training other people how to do it. You're an active investor yourself that you manage. So are you still mostly single-family homes, apartments? What do you invest in yourself?
So my favorite is single-family. It's the most abundant asset in real estate. It makes up about 70% of the housing stock. It's very liquid. It's easy to understand, easy to get into, fairly easy to get out of mm-hmm. because you have a very large exit pool of potential buyers or investors. Mm-hmm. So I love single families, duplexes, and fourplexes. That's really the product type that we specialize in, and that's really most of what me and my team and I hold. Mm-hmm. But I've invested in apartments. I just closed on a 22-unit package a couple months ago in Florida. Mm-hmm. So whatever can generate wealth, create wealth, and create passive income, and is a prudent play, a prudent investment from day one. So you've got positive cash flow. It carries itself. And it's in a market and a neighborhood that will appreciate over time. That's a smart investment. Mm-hmm. You have to have all those elements. I call cash flow the glue that holds your deal together. So you have to have that cash flow because equity grows over time. Mm-hmm. Appreciation happens over time. It just has to in an inflationary environment like we have. Mm-hmm. So if you can have the longevity, the sustainability to be in the game and invest intelligently, you will become wealthy.
What are the hazards? What are the potential pitfalls for getting into the type of real estate investing that you recommend?
One of the biggest mistakes I see investors make, and I made this myself early on multiple times, mm-hmm. is thinking that I'm going to dip my toes in the water or I'm going to start small, which means for a lot of people that I'm going to purchase a $40,000 or $50,000 rental property, which often is in a C minus, maybe a D class neighborhood. Mm. The problem with that is a couple-fold. Number one, and I'm being careful in what I say, but the facts are the facts. If you look at the tenant class or the demographic of the people that live there, they typically don't have a high regard for the property that they're living in. They're more transient. Mm-hmm. They tend to create more damage. They have more problems, mm-hmm. self-created or otherwise, mm-hmm. That just create headaches and hassles, whether for you and or your property manager. Mm-hmm. Number two, that $50,000 property probably was $50,000 10 years ago and probably will be $50,000 10 years from now. Mm-hmm. So if your goal is to create wealth, create equity, grow your equity so you can leverage that into more real estate and increase your passive income, that's not the place to do it. So don't start small in terms of these inexpensive properties in D-class neighborhoods. Mm-hmm. Now, everything's relative, of course. Coming from California or even in Salt Lake City, mm-hmm. A C-class neighborhood may not be $50,000. It might be $100,000 or $150,000, mm-hmm. whatever it may be. But you need to start the right way and continue to build your portfolio the right way, which means that you are following your investment criteria. So you set your investment goals, you break that into an investment criteria, and you follow that criteria because that is your playbook or your recipe for what you're going to be investing in. And it'll tell you where you're investing and what you're investing in. So that's the first mistake is starting small supposedly, but buying inexpensive properties. Don't do that.
So you mentioned one key mistake that you've made, starting out and investing in real estate. What are some other ones?
So one of the other mistakes I made early on is I hired my real estate agent, who was my acquisitions person at the time, to be my property manager. So she supposedly knew how to manage properties, and she probably did a good job, but I wouldn't go as far as saying she did a great job. The problem is that she had to split her time between working with clients as a real estate agent and being my property manager. But really where the the proverbial crap hit the fan happened was when she collected $6,000 of rents in cash. It was a market where a lot of people paid with money orders and cash. She took $6,000 of that and never sent it to me. She claims she had sent it to me. She claims she had dropped it off at UPS, but there was no tracking. And so I never received that $6,000 for that 1 month of collected rents. And my mistake was just using the wrong person, for the right job. I needed a professional property management company.
Wow. Okay. Yeah. That I'm sure early on was a mistake that hurt not to get it. The $6,000.
Yeah, because I had mortgages to pay.
Yeah. Wow. Interesting. So okay. Well, that's a good one to learn from. What else?
A big one is choosing the right neighborhoods. Again, you want to invest making the right decisions right from the beginning. And investing in real estate should not be based on price or what you can afford. It should be, what do I want to get from my investment? Am I after growth or cash flow or a combination of the two? What type of tenant or tenant demographic do I feel comfortable with? Do I resonate with? Do I want? And so for me, we classify neighborhoods as A's, B's, and C's and D's, and more granularly, A plus, A minus, etc. So for me, the sweet spot lies in what I would refer to as a B plus and A minus neighborhood. It's kind of the best of both worlds. I know I'm going to have appreciation potential going forward. I know there's an exit strategy there. There's a retail market, so if I ever need to sell that property, I can. But at the same time, I'm not going into premium areas where the pride of ownership is so high that there is no cash flow because the properties are just very expensive and the cash flow is just not high enough to meet the operating expenses and the debt service for that property. So I like the range of B to A neighborhoods. The mistake I made early on is I was investing heavily in C-class neighborhoods, and they look great on paper, but the reality is that when you have tenant turnovers, they're costly. They'll wipe out the entire cash flow for that year. And unfortunately, there's very little to no appreciation in many of those markets, those neighborhoods. So you really don't stand to gain anything at the end of the year. I didn't know that at the beginning. I was still a relatively green, out-of-state or long-distance real estate investor. But having learned what I learned through experience, which is the best teacher, I've become a very seasoned and effective and efficient investor. And now I know exactly what to look for, and I can identify it within 5 minutes.
Is there milestones where you're kind of graduating in this world, saying, okay, I did my first property, in the style that you're describing. Then I was able to add a second, maybe a third. At what point am I in a new category? How many properties do I have? And I know that maybe what kind of properties you're talking, but let's say they're $100,000 or so single family homes. At what point am I going from kind of an initial investor to a little bit more of a matured place? Like and at what point do I have to hire more staff and team? What's kind of the milestones in this path?
So some investors choose to build a portfolio where they get to 5, 10, 15, 20 single family homes or duplexes, and they have enough equity where they cash out of those, not by just simply selling them, because then there's the taxation, but they 1031 into larger properties as they go. So they move from single families to duplexes and fourplexes, then ultimately they take the equity in those fourplexes and they start getting into small and then ultimately medium-sized apartments. That's one direction. The other direction, or strategy, if you will, is to continue building a portfolio of these 1 to 4 unit residential properties, and there's nothing wrong with that. We have a client, for example, his name is Lance, and he started off with 0 properties, bought the first 4 very quickly within 1 year through us, and to this day has bought over 35 single-family homes. And he's got a passive income of over $10,000 a month. He's got a great portfolio and a lot of equity. He doesn't have any desire to move into apartments. He understands and loves the single-family unit of real estate, and he's happy there. So there's no right or wrong. It's really just what you're comfortable with. From a time perspective, I'd like to think that you should probably budget 5 to 10 minutes per month, per property, or per unit, per door. Really, that's just accounting. You're just reviewing your statements each month, communicating with your property managers, which is usually by email, if and when necessary, and just managing and overseeing. So you're the CEO of your investment empire, if you will. You oversee your property managers, who are your frontline management. They're managing your assets, and they're handling the accounting. And everything else can be automated. Income comes into my checking account every month from the properties in each LLC, and then I have auto payments set up for principal, interest, taxes, and insurance. So I have inflow, I have outflow. What's left over is my net cash flow, and it just sits there in the checking account until I redeploy it into more properties or other investments.
Is each investment a separate LLC, or do you hold all your single-family homes in one LLC, apartments, and how do you? What's your entity structure?
So that question is an asset protection-based question. There is also a tax element to that. So I'll give you a 40,000-foot answer to it.
Okay.
The general rule of thumb, and I am not an attorney, and I do not want to be one. The general rule of thumb is that you will hold your property assets in LLCs in the state that they reside. So if you have properties in Atlanta, Georgia, you're going to create one or more LLCs in the state of Georgia, and you will title those over into a disregarded entity, an LLC. Disregarded simply meaning that it is not an operating business. The taxes come in and go out, they flow through, and you just report it up to whatever the holding company is. The purpose for that LLC is simply for asset protection. Now then the question becomes, how many properties do I hold in that LLC? The better question to ask is, how much equity do I want to hold in that LLC? Because you can have 5 properties in there with no equity, then there's nothing to go after. If there's a lawsuit, there's nothing to sue for.
Right.
I'm not suggesting you do that, but really it comes down to a comfort level. You have to draw the line in the sand and say, okay, when I get to $100,000 in equity, I'm going to split out any multiple properties that I have in an LLC into other LLCs and just keep it diversified, if you will, that way. This is a conversation between you and your asset protection attorney. What I wouldn't do is put everything you own in one LLC and think that's good or okay. It typically isn't, and I don't think any asset protection attorney would tell you to do that.
I imagine, though, you can get insurance, to cover a lot of this too, and it may be an umbrella policy to, kind of be a buffer between what your liability is and what the assets are?
Great question. Always have insurance. That's not even an option or a discussion point. So you will always have property insurance to cover for the basics, hazard insurance. You'll always put $1 to $2 million of liability insurance on your properties, each property. Then in addition to that, you'll want gap insurance or umbrella insurance to backstop anything that wouldn't be covered by that. So insurance is not an option. You always insure everything you own, and then insure yourself, and insure everything through an umbrella policy is just a backstop. So that is in addition to the entities for asset protection.
Who shouldn't do this? So now, everything you're laying out says, my gosh, this seems like, the best type of investment, for wealth development, et cetera, for all the reasons we discussed. Are there some people that you'd say, this is not the right type of an investment for you? You should be looking in other directions.
I would like to think that everyone should own real estate, but the reality is a lot of people are just not financially responsible. Unfortunately, in our school system, we don't have financial education, very little to none. And so people graduate, high school and get into college, and they know very little about money and how it works. And if they knew, what an asset is and what it can do and how to create passive income, and know that there are other options than just having a job where you're just exchanging time for money, where you can actually put money to work, and it doesn't even have to be yours. It could be OPM, other people's money, where you're putting other people's money to work for you, which is what we do all the time as real estate investors, all the time. We leverage our investment capital 5 to 1. In fact, I've done many deals where I've put in 0. I've leveraged 100% of it and still been cash flow positive. That's possible to do. The point is that I'd like to believe that most people, if not everyone, should own real estate. The reality is a lot of people don't understand finance, don't understand money, and are not financially responsible. They have a consumerism mentality, and if you gave them $1 million, a year from now, they'd be broke because they would blow it all. So no, it's not for everybody. You need to, again, have the ability and the willingness and the knowledge to invest. And you can gain those things. You could become those things. The knowledge is out there. In fact, a lot of it's free. It's given away free all the time.
So you mentioned these 10 rules you have. Can you share, you said the first one's education, educate yourself.
Yes.
So can you share some other ones?
Yeah, so a big one is to be market agnostic. And let me explain why this is a big one. Being market agnostic, and this is really where I started in 2004, when in 9 months I had purchased 84 doors, 84 units. So in a very short period of time, I had amassed a pretty large portfolio. But none of it was in California. In fact, I wouldn't touch California with a 20-foot pole. It's just too expensive. The numbers don't make sense. It's a high-risk market, a lot of downside. In fact, we're depreciating in most markets in California right now. So it's not a place I would want to be anyway. But being market agnostic is understanding and realizing that here in the United States, we have over 400 metropolitan statistical areas. And every market is local. In fact, you could argue that every market is hyper-local. What's happening in Detroit, Michigan is certainly different than what's happening in San Diego, California, which is certainly different than what's happening in Salt Lake City, Utah. Every market has its own drivers and dynamics. So what is happening in terms of price growth, population growth, positive or negative, the rental market, et cetera, differs dramatically in some cases between markets. So if you want to be an intelligent, prudent real estate investor, you have to understand that you need to put your capital to work in the markets where it's going to work the hardest for you, grow the fastest, and generate the highest rates of return, cash on cash return and total return on investment. How do you do that? You pick a market that has immediate cash flow, an immediate rate of return, and growth potential. And at the core of that is really just jobs and job growth.
Right.
So you have to be market agnostic in order to be able to make those intelligent decisions. Meaning, you can't be married to a market. Unless you're market agnostic, you're not going to be a very successful real estate investor. The analogy I like to use is this. I do tons of research, and I determine that Coca-Cola is the greatest stock to buy today. However, I don't live in Atlanta, Georgia, where the corporate headquarters of Coca-Cola is located. Therefore, I cannot buy Coca-Cola stock because I'm not in the same market. How ridiculous is that?
Right.
So when you separate yourself from the markets and you choose markets based on the fundamentals and the trends and what's going on, you will become far more successful than you would otherwise.
So that makes perfect sense. You want to go to where the stars align, basically, for what your investment is, not where you are geographically. What other rules do you have?
So geographic diversification. So I hate when stock brokers and financial advisors say you should diversify, because really they're saying let's not diversify. We're just throwing darts at the wall and just seeing what sticks. The reality is a lot of stocks will go up and a lot of stocks will go down, or funds will go up and funds will go down, and you can't really predict with a high degree of certainty what's going to happen. So how do you safeguard against the changes in the market, which is emotionally driven, very psychologically driven, and you have very little control over? You diversify. Well, in real estate, you can diversify, but intelligently. And the way you do that is you diversify geographically. We already talked about markets being different. And what happens in one market is different than what happens in another market. A very simple example is the more recent announcement by Amazon, where they were trying to find, HQ2, their second headquarters. Well, that was a big deal because it's going to bring thousands, if not tens of thousands of jobs, plus a bunch of businesses that will surround themselves around that Amazon distribution center, because they want to be right there to just drop off inventory quickly and cheaply to have wide distribution. Well, that just brings a lot of jobs, therefore population growth, therefore demand for housing. And so now you have upward pressure on prices, and you have demand in the rental market, and rents will go up as well. Knowing that, you have to be market agnostic, like we were talking about. But it allows you to invest in other markets because of dynamics that are going on. So my rule of thumb, very quick and dirty, is basically if you're building a real estate portfolio, do 3 to 5 in 3 to 5. What does that mean? It means pick a market that aligns with your investment goals and your criteria. That could be Kansas City, Missouri. It could be Atlanta, Georgia. It could be Dallas, Texas. And you invest in 3 to 5 properties in that one market. Now you have a footprint in that market. You have a management company managing your small portfolio of 3 to 5 properties. You can grow it beyond 5 if you want, but have that footprint in that one market. When you get to about 5 properties, identify a second market that's geographically different, and often that'll be in another state.
Are they almost always you keep saying metropolitan areas? Are you sometimes going more rural, or are you sticking close to the metropolitan areas?
Well, that's a good question. It's in the MSA, the Metropolitan Statistical Area. So if you look at a place like Dallas, it's made up of many submarkets, which are actually independent cities. They're not Dallas proper.
So you include those in?
Yeah, I'm talking in general terms, like the Dallas metropolitan area. I wouldn't say you're investing in Dallas, the city of Dallas, or in McKinney, or necessarily, Arlington or anywhere there. It really depends. Again, like I said before, real estate is hyper-local. So you have to you start off by looking. This is actually one of my other rules, is take a top-down approach. You start with the market and work your way down to the sub-market, and then ultimately to the neighborhoods, and then you're investing in properties that are specific to that neighborhood. That's how you get into the hyper-local aspect of real estate. So when I talk about Dallas, I'm really talking about regions within the Dallas metropolitan area, which is another conversation. But I would just want to be clear. It's not that I'm saying anywhere within the city of Dallas or the metropolitan area of Dallas.
Right. So yeah, and I think you answered my question, because I'm saying, okay, when you're saying pick 5 or invest in 5 and move to another area, you're saying completely outside of the Dallas metropolitan area if the 5 are in Dallas. Okay, that's what I was trying to get at. Okay.
Right. So we're going to buy 3 to 5 properties in the Dallas metropolitan area. We'll identify specifically where. The data's out there to figure that out pretty easily. So once we've done that, you could do that in the course of, let's say, 3 months. You could do that in the course of 3 years. It doesn't matter. You've got a footprint in Dallas, in the Dallas metro. Now we're going to pick another market. If I've identified Jacksonville, Florida as being the next growth or hybrid market that I want to invest in because it aligns with my investment goals and criteria, we start building a 3 to 5 property portfolio there. And then we do that one more time in a third market. And we can do 4 or 5 different markets if we want. But that creates a great foundation of having about 15 properties spread across 3 metropolitan areas. And that's the place to start. You can continue to build it from there, depending on what your strategy is. You can just accelerate the payments, pay them off, and have 15 properties kicking off $1,000 to $2,000 a month, in income, and live off of that. Or you can take a fast track and accelerate your portfolio growth by taking that equity that's growing in those properties and refinancing or doing 1031 exchange and redeploying that equity into more property to build a larger, faster portfolio. So ultimately, when you do get into your cash flow strategy, it'll be much, much larger than what it would be just taking a kind of the slower approach, which is 3 to 5 and 3 to 5.
Great. So those are, I think, some pretty good rules. Any other ones that come to mind?
So another rule of thumb is really, my 8th rule, and that is use professional property management. It's kind of like a no-brainer in a sense. There's no reason why you should be managing your own properties. I think your time is more valuable than, let's say, an 8-9% management fee that you'd be paying to a management company. So I would rather spend my time with my family, focusing on the things I'm loving and passionate about, and looking for more investment property than trying to manage my properties, which may not be time consuming, but it's just not something I want to do. I refer to property management as a thankless job. It's not something I would ever want to do. I certainly would want to start it as a business. So let other people do it, and that's just my rule.
That was definitely over the years an inhibition for me. Is the idea of being a landlord just was never attractive to me. But you're saying there's professionals that can handle this for a small piece of the income.
Right, and so they're professionals. They understand the tenant-landlord laws. They know how to deal with tenants, properly screen, qualify, and place them. Why should I be doing that, especially from 2,000 miles away when I'm investing in other markets, when I can have someone do that easily, quickly, professionally, and minimize my downtime? Another rule is my 10th rule, and that's a key rule, if you will, but it's just a benefit of investment real estate, and that's leverage. The fact that you can leverage your investment capital with real estate 5 to 1 is incredibly powerful. It's a powerful wealth creator. So I can take $20,000 today and purchase a $100,000 3-bedroom, 2-bath home in a market like Indianapolis, parts of Houston, Memphis, markets within Alabama like Montgomery, Huntsville, and do very well with that property. I'll have a very good cash-on-cash return, but I'm only putting 20% down, and I'm borrowing the other 80%. But guess what? I get 100% of the benefits. I get 100% of the amortization on the loan, 100% of the appreciation, 100% of the tax benefits, 100% of the cash flow. And I also benefit from the fact that my 30-year fixed rate mortgage is being amortized, not just by the payments that come in every month that, by the way, my tenant is paying, not I, but inflation is eroding 2 to 3 or 4% of that loan every year. So I'm getting kind of this phantom or invisible rate of return each and every year just from the forces of inflation. The bank is not benefiting from it. I am. They're not readjusting for inflation. It's to my benefit. So being a debt holder, meaning that I'm borrowing the bank's money to purchase income-producing assets for myself, makes me a beneficiary in many, many ways.
Yeah, that's interesting because, just thinking about having $20,000 sitting in cash somewhere, and maybe getting some small insignificant return as compared to saying you could leverage up, have all the advantages you just described, seems like a very unique opportunity as far as trying to build wealth with smaller resources.
Yeah, I'd like to think that most people should start with $100,000. And believe it or not, a lot of people have access to $100,000. They don't even realize it. And this is true for the coastal markets, the expensive markets like California, even in Utah, New Jersey, New York, where they have $100,000 or more sitting in their property, whether it's their principal residence or maybe a second home or investment property. I call that dead equity, dormant equity, idle equity. The fact is the return on that equity is zero.
Right.
But what if you could take that equity, even if you're borrowing against it, let's say $100,000 at 6% interest-only loan, which is only $500 a month in payments, but you can turn that $100,000 into 4 or 5 income-producing properties in the Midwest or in some of the other markets that we're in. Now all of a sudden, you've not spent that $100,000. You've invested that $100,000. All you've done is you moved it from your IRA, self-directed IRA, principal residence, other property, wherever it may be, and you've turned that into 4 or 5 rental properties that are now creating cash flow for you and creating wealth through gains in equity. And in 5 years, you can take that newfound equity and rework that. You can pull it out or refinance and turn that into a larger portfolio and increase your passive income and accelerate your wealth creation. So anybody that can come up with $100,000 immediately, whether it's savings, income, or otherwise, and turn that into a small portfolio of 5 properties, and every 5 years you essentially refinance and rebuild and build up, leverage up your portfolio, in 10, 15, 20 years, you'll be amazed at what you've created. That is how you can get to financial freedom. And I break financial freedom into four categories, if I can touch upon that.
Yeah, please.
So think of it as a pyramid. The largest part of that pyramid is essentially what I call financial frustration. This describes a lot of the American population where they just can't seem to get ahead. They're always chasing their tail. They just can't get a break. They're always broke. Whatever the case is, they're financially frustrated. Even people who have regular income from a W-2 job feels that way. But when you break out of that, you get to a point where you have financial stability, and this is often what happens when people get married. Now they have 2 incomes coming in, and there's some more breathing room, or you get a promotion, or whatever the case is. But when you're financially stable, you're making ends meet. You're not overly stressed. You're living paycheck to paycheck. Maybe you're putting some stuff away, but your income is typically coming in from active income. You're working for it. Right. When you start investing with the mindset of building passive income, what happens is you go from financial stability to financial independence. You've achieved that when you have predictable and sustainable passive income coming in. And that's the key. It's got to be passive income because it needs to be 1 to 2 times your living expenses. If you were to lose your job or quit your job, you can still maintain the same lifestyle that you have because you've got 1 to 2 times your monthly income. You're covering the nut, as they say. But it's got to be predictable and sustainable. Then that last layer, that small tip on that pyramid, is what I refer to as financial freedom. At that point, you've achieved 3 times or more. Ideally, it would be 10, 20, 30 times, whatever your monthly living expenses are. And that's just a matter of what your financial goals are. You set those goals, not I. But financial freedom is when you have true time freedom. You have enough passive income, which is reliable and sustainable, coming in that you don't have to worry about anything financially. You've You've achieved everything you wanted to achieve financially, or maybe not, but you've got everything that would be a concern covered. And now you can get on to bigger, better things about your mission, your purpose, whatever fulfills you, spiritually or otherwise. Mm-hmm. And that's really a great place to be, because you can sleep in the morning, you have no stress, you can give back to the community, you could do things, go on a mission, whatever it may be.
Well, Marco, we've covered a lot of ground and explored what I think from a wealth creation standpoint, it's really a magical world, this whole world of real estate and the way that you approach it. So I really appreciate you taking the time to share all your experience with us.
It's been my pleasure, Patrick. This has been a lot of fun.